Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade. But before we do, the required disclaimer. This presentation is given for educational purposes only. We're not broker dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and make sure you are aware of all your risks prior to placing any trades. Also, please note that we're using hypothetical computer simulated trades and the results in the presentation. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Lock in Your Success LLC, and myself and my team are here to help traders win in the market and in life as well. And today I'm here to guide you into the realm of high probability income trading. Now in a moment, not now, but in a moment, we're going to go over the winning trade. But before we do, let me quickly explain what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction. Meaning we can often make money whether the price goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning are much higher than they would normally be. Now, when you find that you want more information as you're following along, simply contact us at lockinyoursuccess.com or ask a question in the comments on this video and we can direct you to where you can find more information or I can answer your question. So let's move on. The winning trade we're looking at today is called the V32. This is a shorter term broken wing butterfly strategy that we trade on the Russell 2000 and regularly track in our options trading for income webinars. It's a fairly simple income strategy that's easy to manage and can be traded with as little as $3,500 per trade. The entry date varies depending on when the previous trade was exited, but for the purpose of demonstration, we will start this position 30 days to expiration. It has an exit loss trigger of $250 per butterfly, which would be 7.1% of planned capital. As far as a win rate, it historically wins over 80% of the time. The position has no profit target, but the average win historically runs about 5.5% of planned capital per month, with larger monthly wins being in the 13% range. Now, this strategy can be entered one of two ways. As I was saying earlier, we can either attempt to adapt to the market by varying our entry date based on implied volatility and when we exited the last trade, as we demonstrate in the V32 trading program itself, or we can simply start 30 days to expiration as we do in our weekly options trading for income webinars available with our Go level membership. Today we're simply going to enter the trade 30 days to expiration, mainly because the trade is easier to demonstrate this way. So let's take a look. So it is now Wednesday, November 20th, 2019. It is 30 days to expiration for our December 2019 expiration options. For those of you who have not seen this type of software before, this is called analytical software. This shows the strikes of our options. We have our call options on the top. We have our put options on the bottom. We have what we call the analytical graph, and we have the straight or sharp-edged blue line that looks like a triangle. That is referred to our expiration graph. It is the value of the position at any price point of the Russell 2000 at expiration, which is 30 days into the future at this point. Our curved line here is called the T+0 line. It gives us the approximate value of the position at any price point in the Russell 2000 as estimated by the software. And as time goes by, you'll see this curved line come in to match the sharp-edged triangle line. And our profit and loss is going to be here on the left side in dollars, on the right side in percent based on how much capital's in the trade at any given time. And then of course we have our asset price along the bottom. And if we look into this box here, this shows us our profit and loss, delta, gamma, theta, and vega at any price point. If we drag the cursor, you kind of see that happening. And down here we have the current margin or how much is in the position. We show our commissions right in here. We show our profit and loss in dollars, our current profit and loss in percent based on how much is actually in the position, our delta, gamma, theta, and vega of the position at any given time. So this is how this position starts. Initially, we're going to start out with a 60 40 broken wing butterfly, or at least we're going to model a 60-40 broken wing butterfly. So by that I mean we're going to have the lower wing, or this is what's called the lower wing, and that's going to be 60 points between our short strikes and our long strikes. And then we have an upper wing, which is right here, which is going to be 40 points between our short strikes and our long strikes. If I were to do that, if I was to take out these 5 strikes and I were to put them up here, this green would be an actual 60-40 broken wing butterfly. Now, when we go to enter this, depending on how close to expiration we are and what the implied volatility is at any given time, then we're going to have a different delta. We're going to call it different delta. And delta is down here. The position we're actually entering is 3.52. If I were to do a 60-40 broken wing butterfly, our delta is minus 28. Well, in this position, when we enter, we want a positive delta, and we want it relatively close to 0. So what we're going to do to correct for that delta being off in this particular case, we're just going to take 5 of these 1610s, we're going to bring them down to 1600, which means we have 5 broken wing butterflies with strikes of 1510, 1570, and 1600, and we have 5 with strikes at 1520, 1570, 1610. And this is going to be our starting position. Now, if the market comes down too far, we're going to do what we call a rollback. In other words, we're going to sell the position that we have, and we're going to move it. If the price goes up and becomes negative delta, then we're going to make an adjustment to make it positive delta again. So this strategy is designed mainly to deal with a trend. So the market can go up quite aggressively, and it's very, very unlikely you would have a problem in that direction. It's very unlikely you'd have a problem if the market was relatively sideways or choppy. And you won't even have a problem if the market comes down a fairly good amount at a fairly good speed. But you will have challenges on a very hard, very fast down moving market. So this is what the strategy looks like on entry. If we go to the first adjustment day, so right now it's November 20th, and the next adjustment is only 2 days away on the 22nd. What happened here is a little bit of time went by. We're up $785. Like I said, the curved line's going towards the more triangle line here, and we're up $785, but we've gone negative delta. This particular strategy, we do not allow negative delta on the T+0 line. So what we're going to do is we're going to take 5 of these 1610s, we're going to bring them down to 1600, like this. And this is going to be the resultant position. At this point, we are now positive delta. We're positive 31 delta. We don't actually have a positive delta limit on this. What we do have is a downside adjustment trigger depending on how wide the upper wing is. So if we have a 40-point upper wing, in other words, we have our short strikes at 1570 and our long strikes at 1610, we have an adjustment point at the money on the short strikes, which would be 1570. If we take 5 of these and bring them down as we were in our entry position, our adjustment would be at 1575. If we bring all of them down to 1600, our downside adjustment point is 1580. And if we were to bring them all down to 1590, our adjustment point would be at 1590. And if we bring them all the way down to 1580 here, our adjustment point would actually be at 1600. So we're varying our adjustment point to the downside, not based on delta or profit and loss or anything like that, but just based on how we are positioned with our upper wing. So right now we have a 30-point upper wing. We have 31 positive delta. We have a 60-point lower wing. Our capital in the position is right around $30,000. And I can tell that because it's the lower part of my blue line. This is the maximum amount that could be lost in the position at this point if say the market were to go down to 200 or 300 points tomorrow, then that is the maximum potential loss that we could possibly experience in the position. Although we would like to be out of this if the trade actually drew down $2,500. So this is what we have on November 22nd. Let's go to our next adjustment point, which is 3 days later, November 25th. So at this point, we get a very large up move for the Russell. It's 34 points. Usually the up moves on the Russell are slower than this. 20 is usually considered a fairly big move to the upside. This one's 34. Now, ideally in this position, we would have the market neutral or not move a whole lot. The next best case scenario is that the market moves up kind of gradually. If the market moves up kind of gradually, we can get some really, really nice profits out of this. If the market moves up really, really fast, it's generally not a problem, but it will create a situation where we don't get the higher profit numbers. Our profit numbers, in that case, tend to be a little bit lower than they would be in the other two scenarios. So here, we get a really good sized up move. We go negative delta again, and we're going to bring these 5 contracts now down. Now, when we do that, we have what we call a planned capital in this trade of $35,000, which means the most we're going to allow into the position for a risk to the downside would be $35,000. This does not put us at that risk number. However, we do have regulations in the strategy relating to the upper size wing. When the upper wing gets to this point, when I have to make this adjustment to the upside, to the upper wing, I also bring in the lower wing so that we reduce our total downside risk in the position. And that reduces problems with the risk of reversal, and it makes our delta so it's not quite as high as it would be if I just simply did this adjustment. I'd be at 17. When I add this in here, it really cuts down on the reversal risk and the sensitivity to implied volatility that a position would have otherwise. So that is the adjustment we're going to make. If I uncheck my ignore trades, you can see this is the new position. We now have a 50-point lower wing, a 20-point upper wing, and a 30-point upper wing. We have positive delta, and we have a profit and loss of $895. Let's move forward. So what happens here, we go a couple more days, we're at the 27th. We get a continued move up in the index, and our delta has pushed negative delta once again. So we're going to make this adjustment. That's going to put us at a positive 19 delta. And if I show the new position, we are now positive 19 delta, and we're now up $1,060. We have a 20-point upper wing, a 50-point lower wing. We have on our T plus 0 line, you can see it's going to try to go up towards this triangle. And if we look at the maximum amount we could make to the upside at this point, it's about almost $1,600. So let's move forward. Let's see what happens here. So nothing happens with the position until Friday the 13th. Ooh, that's a scary day. So Friday the 13th, we actually have a down move. But one of the interesting things that happens is a lot of times we'll have a down move and we will go negative delta in the position. So at this point, we're 7 days to expiration. We had a down move. We're now negative 12 on the delta. So what we want to do is we want to roll in this upper long. And we're also going to, once again, when we get to this positioning, move up these lowers, and we're still negative delta. So what we're going to do is we're going to take all 10 of these and bring them down. And now we're looking at about positive 10 delta. And we have about $27,000 or so into the position. We have a profit after adjustments going to be about 17.95 after commissions and so forth. We'll be positive 10 delta. We'll have a 40-10 broken wing butterfly here. And let's make that happen. So this is our new position. This is also the maximum upside adjustment that's allowed on the position. So we're not going to make any further upside adjustments at this point. We do have a rollback point in this at, if the index comes down to 1600. So if we get back down into here, we're going to reevaluate whether or not we want to be in the position or roll it back or what we're going to do at that point. Unless that happens, we're basically doing nothing here. So let's move this forward. At this point, we are only 2 days to expiration. We're at a profit of 1870, which is pretty much all we're going to get out of the trade. Our options down here are pretty much worthless at this point. We're also 30 days to expiration for our next trade, so we're going to want to go into that trade at this point. So what I'm going to do is I'm going to close this out. And that is going to give us a profit of $1,830 on $35,000 planned capital. Of course, we never got $35,000 in the trade, and we actually never will. It's actually going to stay under $35,000 at all times. So that's $1,830 on $35,000 in planned capital, or 5.2% in 28 days. Not bad at all. And that, my friends, was the V32, a very simple, very effective, shorter term, broken wing butterfly trading strategy. This episode's winning trade. If you like what you see, I encourage you to join us and discover how you too can follow along with this and many other great strategies as they unfold during our weekly Options Trading for Income webinars. And where you can also learn about our upcoming winning trade presentations and our trading success blueprint. And perhaps best of all, you can get information about our free trading performance podcast where you can learn to become a much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on this video below so we can get those answered for you. And we would also encourage you to come on over to thewinningtrade.com where you can find past episodes of The Winning Trade as well as a lot of other fantastic bonus information on how to profit through income trading. And please remember to subscribe and comment on our YouTube channel where I can personally answer any questions you may have. Thank you, and we'll see you on the next winning trade.